Welcome to another Explainer. Today, we are diving headfirst into a really fascinating financial mystery from United Natural Foods, Inc., or as they're commonly known, UNFI. You see, in the whole grocery supply chain world, the typical playbook is almost always about scale. Move more boxes, load more trucks, and drive that top-line revenue as high as humanly possible. But today, we're completely flipping the script. We're going to explore how UNFI engineered a scenario where making less money on the top line actually resulted in keeping a whole lot more on the bottom line. It is literally a masterclass in prioritizing the quality of revenue over the quantity.
So let's just get right into it. How in the world does a massive grocery distributor actually see a drop in overall sales, but somehow manage to massively grow its profits? I mean, it kind of defies basic retail logic, doesn't it? Usually, if fewer goods are moving through your giant warehouses, your profit margins just get crushed under the sheer weight of all those fixed costs. Think about it. If you're paying to keep the lights on in a massive distribution center, you want that thing packed to the brim. But for UNFI, in Q3 of fiscal 2026, the exact opposite happened.
Just look at this stark contrast. On one hand, their top-line revenue actually shrank by 4.2%, landing at $7.72 billion. But then, look at the other side. Their adjusted earnings per share didn't just hold steady, it skyrocketed by 75%, up to 77 cents. And right alongside that, they posted a 16.6% jump in adjusted EBITDA, hitting $183 million. So they essentially brought in less total cash at the register, but became drastically more profitable overall.
Okay, so to really solve this mystery, we've got to look past the spreadsheets and think about the physical reality of what UNFI actually does. We aren't talking about a software company here. This is the gritty, super complex world of physical logistics. We're talking conveyor belts, corrugated boxes, massive warehouses, and fleets of 18-wheelers. The real answer to our paradox lies in how management decided to fundamentally change the way those physical assets operate day in and day out.
You see, this drop in sales, totally not an accident. It was actually a highly deliberate strategy that management calls, get ready for this, accretive conventional product-focused network optimization. Yeah, I know, that is an absolutely terrifying piece of corporate jargon. But what does it mean in plain English? Basically, they trimmed the fat. They looked at their vast network and actively made the tough call to stop doing things that simply weren't making enough money.
So what does trimming the fat actually look like on the ground? Well, they intentionally exited their facility in Allentown, Pennsylvania, and they purposefully unwound some short-term project-based work. By doing that, they basically created a huge 450 basis point headwind on their own sales. They willingly gave up that volume. Why would they do that? Well, to shift their entire organizational focus toward higher-margin natural products, effectively cutting loose the lower-margin conventional business that was dragging their profits down.
But, just cutting unprofitable channels is only half the story here. You can't just shrink your way to long-term success without actually getting better at what you keep. So they took the resources that got freed up by those cuts, and they aggressively reinvested them into next-generation supply chain technology. And it turns out they are brilliantly doing exactly that, doing more with less. They've deployed an AI-powered supply chain planning platform across 100% of their network. Seriously, the whole thing. Plus, they're embedding a new fleet management tool called Samsara to optimize truck safety and control costs. And on top of all that, they've rolled out a cloud-based warehouse management system to 5 additional distribution centers. This is really the nervous system of modern logistics, allowing them to route goods way smarter and faster than ever before.
Now that number right there, 40, that represents the 40 distribution centers that have now fully implemented UNFI's new lean logistics practices. It's not just slapping in new software, it's a fundamental shift in their daily workflows, and the results speak for themselves. By coupling these new practices with their tech upgrades, UNFI managed to reduce their operating expenses by nearly 7%.
And these tech and lean investments, they are directly translating to major wins on the ground. When we look at their metrics indexed against last year, it's just consistent growth. Their fill rate is up 2 points, which basically means fewer missing items for their customers. On-time delivery is up over 4 points, and their overall warehouse throughput actually grew by 7 points, meaning they are physically pushing more product through the exact same buildings.
All right, so we've peeled back the layers on how they optimize their physical logistics. But honestly, moving boxes efficiently is only great if it actually translates to real financial stability. So let's see exactly how this newfound efficiency strengthened their balance sheet. Which brings us to a super critical indicator of their financial health, 2.5x.
That is UNFI's net leverage ratio at the end of the quarter. In plain terms, a lower number here means less risk and less debt relative to what they're earning. It's actually down a massive 0.8x compared to last year, marking UNFI's lowest level of debt leverage since fiscal 2018. They are systematically taking the risk right out of their balance sheet.
And if you want to see exactly what that de-risking looks like in absolute dollars, check this out. Thanks to generating $54 million in really strong free cash flow just this quarter, they successfully paid down a huge chunk of debt. At the end of Q3 fiscal 25, net debt sat at $1.928 billion. Today, it's down to $1.632 billion. That means they've erased $296 million in net debt compared to this exact same time last year.
Now, what's really fascinating here is that their operational discipline created enough cash to give them some serious options. They didn't just use every spare dime to pay down debt. They had the financial flexibility to go out and actively buy back nearly 1 million shares of their own stock for about $38 million. That is a loud, incredibly clear signal of confidence from management in the intrinsic value of their newly optimized business.
So, the big question now becomes, with this massive pivot toward profitability executing so incredibly well, what does management actually expect for the rest of fiscal 2026? Let's take a quick look at their outlook.
UNFI actually narrowed their full-year guidance ranges, but they successfully reaffirmed their midpoints across the board. They're still expecting net sales to land between $31.1 and $31.3 billion, and adjusted EBITDA between $685 and $705 million. They also expect robust free cash flow right around $330 million. By narrowing these ranges, management is essentially proving to everyone that they have a highly predictable, high-margin model locked in. The wild volatility is fading, and it's being replaced by just really disciplined execution.
I think CEO Sandy Douglas summed up this whole quarter perfectly right here. He points out that this turnaround wasn't magic, right? It was completely reliant on disciplined execution, a crystal clear value creation strategy, and honestly, a really bold willingness to reinvest in their core capabilities. They made the tough choice to shrink their overall footprint so they could create a much healthier core business.
So this leaves us with a totally fascinating industry-wide question to ponder as we wrap up this explainer. UNFI just essentially proved that shrinking, inefficient revenue can actually lead to massive profit growth and a fortress of a balance sheet. In a retail world that is so often completely obsessed with top-line growth, who is going to be the next industry giant to wake up and realize that bigger sales don't always mean a better business? It's a strategic pivot that might just redefine the future of supply chain logistics. Thanks so much for joining us for this explainer, and definitely keep an eye out for who makes the next big move.